Good morning or good afternoon, depending on where you're joining us from. Welcome to today's webinar, which is going to be an Unemployment 101 for nonprofit employers. My name is Nicole Korn, and I'm the Director of Unemployment Insurance Solutions here at 501, and I will be your presenter today. Before we get started, just a few housekeeping items. First, there is a copy of today's presentation located in the handout section of the webinar toolbar. So if you'd like to have a copy of today's presentation, feel free to download it from there. Also, I do plan to leave everyone in listen-only mode to keep any background noise muted, but feel free if you have a question to type it into the question chat box, and I'll stop periodically throughout the presentation to check that. You can also, of course, feel free to reach out to us directly after the webinar as well. If you are interested in having continuing education credits like SHRM or HCRI, this presentation is certified for 1.5 hours of continuing ed credits. And so in order to get the code for the certification, you just have to fill out the survey that you'll receive after the webinar. So after the webinar, you'll get the survey, fill it out, give us about 24 hours to process those, and then they will send you your code for that. All right, so let's go through the agenda real quick. So first, we're going to start with just a quick history lesson because we need to understand the foundations of how the unemployment system was built. Then we'll talk a little bit about how the states determine chargeability and liability. Then we'll talk about the different types of separations and various adjudication strategies. And then last but not least, I'll give you a few tips and stuff for appeals and hearings. Okay, so unemployment, it all began with the Great Depression. In 1929, financial institutions collapsed and many companies laid off workers, which caused the unemployment rate to skyrocket to over 20% nationwide. And it was this event that prompted our government to try to find a means to provide relief to impacted individuals who lose their livelihood. So on August 14th, 1935, President Roosevelt signed the Social Security Act. And Social Security Act contained provisions for elderly insurance, welfare, and unemployment insurance. Now, the U.S. unemployment program is federally mandated. However, the individual states are free to administer the program as they wish, so long as they meet 4 federal requirements. So the first requirement on the list is the replacement of lost wages. And the main objective here is to protect workers from temporary loss of wages. So while the weekly benefit amounts that someone can collect will vary from state to state, unemployment is always only meant to replace a portion of a worker's earnings. So for example, if a worker makes $1,000 a week while they're employed and they get laid off, they're not going to receive $1,000 a week in unemployment. Now, this is in part to provide an incentive to that unemployed worker to return to the workforce. Usually they get, somewhere between 50 to 60% of their average weekly wage, up to whatever the maximum cap is in your particular state. The second federal requirement is stabilization of the national employment. And so the objective here is to create an incentive to employers to retain their workforce by taxing them or charging them on their prior unemployment experience. So if an employer has a high level of chargeable claims against their account, their tax rate charges will be much higher than a company with little unemployment activity. Now, this is slightly different for nonprofit companies that can be exempt from these taxes, but the underlying principle is the same. There is a financial impact for not retaining your workforce. The third federal requirement is stabilization of the national economy. And so the objective here is just to retain some of the consumer purchasing power, hoping to, prevent an economic downturn. So in other words, if someone has no money coming into their home or into their household, they're probably not spending a lot of money out there in the economy. So the idea is to keep some money, flowing through that way. The fourth and last requirement is job placement. And this is actually why state unemployment agencies are the primary job placement bureaus in America. So now, outside of these 4 federal requirements, each state administers its own program. And this is why regulations regarding things like eligibility, benefit amounts, and the length of time that someone can collect will vary by state. However, when it comes to eligibility, there are 5 criteria that are consistent in every state. In order to be eligible for unemployment benefits, the claimant must be physically able to perform some kind of work. They must be available for work. So they can't, be on vacation in Europe and collecting unemployment benefits. They have to be available to work. They have to be actively seeking work. And then they must meet the state's monetary requirement. And there's both a historical component to that, as well as a current component, right? If someone maybe is still working with reduced hours. So we'll talk more about that in a bit. And then last but not least, they must be unemployed through no fault of their own. And, this is the part where the employer has the most involvement or control, if you will. However, it's really subjective, that no fault of your own. It really is very gray area. And we will talk more about that when we get to the different types of separation. So believe it or not, the unemployment program really hadn't changed much, the foundations of it anyway, not since 1935. And that was until President Obama passed the Trade Adjustment Assistance Extension Act of 2011. This was major legislation, and it resulted in new regulations to promote unemployment insurance integrity. These regulations, which went into effect in 2014, actually changed the way that employers need to view their role in the unemployment process. So previously, employers made a choice between responding or not responding to unemployment claims, and often would respond only if they wish to contest the claim. But moving forward, employers are required to respond to all claims in order to remain in compliance with these new regulations and avoid potential penalties. So these new regulations stipulated that state unemployment agencies had to prohibit relieving employers of charges to their account when both of the following conditions existed. So if unemployment benefits were paid improperly due to the employer's failure to respond timely or adequately to the state's request for information to the claim, and if the employer has a pattern of failing to respond timely and adequately. So let's talk about these 3 things: adequacy, timeliness, and what constitutes a pattern. So, adequacy can be a little bit subjective, but a good rule of thumb to ensure that your response is adequate, is to answer all of the questions that are presented to you regarding the specific separation. The answers need to be detailed and concise and contain all necessary supporting documentation. And we'll definitely get more into this later when we get into the different types of separations and the documentation needed. So next, let's talk about timeliness. Timeliness is pretty black and white. Deadlines can and do vary by state and by form type. But on average, the states give roughly 7 to 10 days from the date they mail it out to respond with the adequate info. And, failure to do so could result in penalties, financial penalties, and would count as like a tick on the pattern clause, essentially. So every time you fail to respond timely, it counts against you as having a pattern of doing so. Some states do like a financial penalty as well. So like Vermont, every time you don't respond timely with all the details, it's $100 per occurrence. In addition to the non-relief of charges, right? Maryland is $15 per occurrence. So some states have financial penalties in addition to not relieving an employer of charges. So what constitutes a pattern? Compliance with this is mandatory, but the actual regulations vary again from state to state. But generally, a pattern is established when there are 2 or more instances or 2% of your claims in the prior year that don't meet the compliance standard. So that's not a lot, right? So if you just get a couple of claims that you didn't respond timely to with the appropriate information, you could be deemed as having a pattern of not being in compliance. So what happens once you're not in compliance. So once a pattern is established, the employer loses the ability to receive relief of charges that were paid prior to an overturned decision if it was a direct result of the employer failing to provide pertinent information at the initial protest level. So what does that mean? In the past, an employer could, respond to a claim with sort of just basic information. Oh, they were discharged for a violation of policy. And maybe they didn't give enough information to get the person disqualified, and they start collecting benefits. And the employer says, oh, wait a minute, I'm appealing this. They violated a policy. And then at this point, they provide all of the details and the documentation, and they go to a hearing, and the state overturns it. Well, that person's probably collected in between that initial decision and the hearing decision. And in the past, the states then would return all of that money to employers. And now they're saying, no, we're not going to do that anymore if you don't provide the information at the initial level and you have a pattern of doing this, right? Now, while this legislation might seem harsh, the intent behind it is actually beneficial to all parties. It reduces inaccurate payments. It results in better initial decisions, which is less hearings for you to have to deal with or attend. And it keeps the states from becoming insolvent. So think about it like this. If the employer fails to provide details at the initial level and that person gets benefits, right, they've probably collected hundreds, if not thousands of dollars by the time the claim gets to a hearing. So if the employer chooses to then provide all of the necessary information that should have resulted in an initial disqualification, well, now the state has to try to go back and collect hundreds or thousands of dollars from someone who is unemployed. That's pretty difficult to do, right? And in most states, you as the employer, you don't get the money back until the state gets the money back. I've seen it take 5 to 7 years before this money gets returned. Now, some states are really generous. Like I know Pennsylvania, they give the money back right away and then they work on collecting it, but it does cause insolvency issues for the state. So again, there really is a financial benefit to you to provide all of the details and documentation up front on that initial claim. It is not about protesting or not protesting. It's about helping the state make an appropriate decision per unemployment law, and it is a requirement. So unemployment benefits are 100% funded by employers, either through taxes or through direct reimbursement. It is not uncommon for individuals to believe that, they pay into unemployment, like they pay it into through a payroll tax, and it's some sort of an entitlement or a benefit that they're owed. This is not the case. Now, there are 3 states that do require a small, tiny employee contribution that they might see on their paycheck. Those states are New Jersey, Pennsylvania, and Alaska. However, those little contributions that they see coming out, those go to the state for the cost of administering the program. None of that money goes to actually funding the benefits, okay? Benefits are 100% financed by the employer. Now, when it comes to funding unemployment benefits, there's 2 types of employers. There are merit-rated or tax-paying employers, and there are self-funded or reimbursing employers. So merit-rated employers could be a for-profit or a nonprofit company, and they're issued a tax rate each year in every state that they operate in. And then they have to apply the tax rate that they're issued against a designated wage base, and the wage bases do vary by state. Let's go through an example. We'll use Oregon. In 2023, the wage base in Oregon was $50,900, and the maximum rate you could be assigned was 5.4%. But let's just say you're assigned a 4% rate in Oregon. You're going to pay 4% of the first $50,900 that every employee earns. So that's $2,036 per employee per year, which is $203,600 a year that you're going to pay to the state unemployment agency, regardless of whether you've ever had you could have not laid off or fired or discharged a single person that year, and you're still going to pay $203,600 per year in those taxes. Now, the second type of employer is a reimbursing employer. So nonprofits government government agencies and tribal organizations can opt out of the state unemployment tax system and be self-insured or reimbursing. Okay, and being reimbursing employer can be particularly advantageous for several reasons. Well, number one, they pay only for actual benefit payments issued. They're going to avoid increased tax liability due to an unfavorable economy, and they're going to avoid some of those unemployment tax assessments and socialized costs. So, forgot to mention this, with the tax system, right, they typically use a 3 to 5 year look back period to determine your rate every year. And so one bad year could affect you for many years after. And an unfavorable economy, they're going to pass legislation, they're going to pass changes to tax rate tables and all kinds of things. And there's a lot of socialized costs built into that. And so you, as an individual employer, might not have a lot going on, but if other employers in your state do, your taxes will go up just as a result of that. When you're a reimburser, you don't have that issue. And so, like, during the pandemic, it was a little scary for reimbursers because, you know, they didn't sort of have that tax system to fall back on. But now that that's over, we have historically, like, record low unemployment claims right now, historically low charges. It's a great time to be a reimburser, right? Because now they're just back to paying for what they actually use, and claims are really low, whereas those tax-paying employers are really feeling the pain. The states are passing all kinds of legislation. They got to refund the system. So they're raising rates, they're raising wage bases. And so as that, you know, with that, tax-paying employers are just going to pay more for many years by nature of that. So I think it's really interesting. If you think about most studies that attempt to quantify the cost of turnover, they usually use some sort of variation of turnover cost equals cost of hiring plus the cost of training a new employee, but rarely do they ever consider the cost of an unemployment claim. And they should, because it is a real cost and it directly impacts your bottom line. Okay, so this chart here is just to illustrate the benefit amounts the maximum benefit amounts in each state and how many weeks a person could collect. So just like looking at Washington, state of Washington, right? $999 is the maximum benefit amount for 26 weeks. That's $25,974, that one unemployment claim. And obviously that's max liability, but that's how much one unemployment claim could cost you. So it is a real cost, and this is why we want to talk about how to sort of manage those costs to the best of your ability. Okay, let's just check and make sure there's no questions before we move on to liability. Okay. So here's the first question. If the employer is not contesting the unemployment, do they have to respond? Will they be penalized if they don't? I'm assuming you probably asked that before I got to that part, but the answer is yes, you have to respond. Well, I mean, and if you don't, you're just going to get sort of that, be put on the naughty list, if you will, have a pattern. Depending on your state, there could be a financial penalty. But there's only a couple states that do that. So, I mean, if you don't respond, you're going to be sort of on that naughty list. And so later down the line, in a situation where you might get a hearing decision overturned, you may not be eligible to get that money back. So I would highly recommend responding always. If you think about it, like maybe somebody got laid off and you're not contesting, but if you don't respond timely to the state, that actually is going to delay that person's benefits getting paid, and they legitimately should be paid. So if you think about it like that, it really is a good idea to just always respond timely. The next question we got is, we have ski instructors that sign a seasonal contract for a range of specific dates. I've been told that once their contract is complete for the winter, that this is considered a layoff and they're eligible for unemployment. Trying to understand if everyone is signing a contract for work to be conducted for a specific amount of time. Okay, yeah, so that is a great question, and I'm actually going to cover like temporary and seasonal jobs when we get to the presentation later. So just in the interest of time, I'm going to sidebar that. because I am going to address seasonal work later on. And this webinar is so long already, I just want to make sure we have enough time to cover everything. So I will get to that. So let's talk about chargeability and liability. Why am I responsible for this claim, and how much am I going to have to pay? Those are some of the common questions that we often see from employers. So the first thing that the state is going to do when someone files a claim is they're going to determine the base period, okay? Now, the base period is almost always going to be the first 4 of the last 5 completed quarters. Now, there's like a couple exceptions, okay? Massachusetts uses the last 4 completed quarters, but almost every state uses the first 4 of the last 5. So this chart here is to help you kind of figure out what that base period is. So if you look at where the arrows are pointing in those white unshaded boxes to the far right, that's your filing month. So right now we're in the month of August. So that's like that third box down there on the right. So you can see if someone files a claim today in the month of August, if you look to the left, the shaded gray area is going to be that base period. So if someone files today, the base period the state's going to use is April of 2022 through March of 2023. Now, you're probably wondering, like, that's weird. Why do they use the first 4 of the last 5? Like, what's the point of sort of this blank box or this lag? We call it the lag quarter. It actually makes a lot of sense. So when the state is trying to determine, someone's eligibility, if you will, and how much money they've earned in the base period, they've got to have the employer's reported wages from each quarter. And at the end of each quarter, you've got roughly 30 days to send those reports in. And so if they use the last 4, like Massachusetts does, if the person files at the very beginning of a quarter, the state doesn't have the most recent wages yet. They wouldn't have that information. And so states like Massachusetts, they have to send a manual questionnaire to the employer that they have to fill out, and it's a big pain. So most states do the first 4 of the last 5 for that reason. It gives enough time for the state to get all of those reports in and have all of the information. Now, what is the purpose of the base period? Like, what are they using this information for? So first, it's going to tell them, has the claimant met the minimum wage requirements in your particular state to qualify for unemployment? They had to have worked long enough and that's, earned enough wages in order to be eligible. Then it's also going to tell them how much the claimant is eligible to collect if they're eligible and for how long. It's going to tell them which employers will receive a claim and what type of claim they'll receive. And it's going to, if the claimant is found eligible, it's going to tell the state how much each employer has to pay. Okay. So one of the questions that we often get from employers is, this person left a year ago. Why am I getting a claim? Why am I being charged for this claim now? They quit here and they went somewhere else and worked. And this is why. It's because of this, we call it the look back period or the base period. It's all the employers that paid wages during that period that are going to be involved in this claim. So let's walk through a specific example to illustrate this. So in looking at this graphic, you will see that there are 3 companies involved in this claim. We've got Company A, which is both the last employer or the most recent separating employer and a base period employer. We've got Company B, which is a base period employer only. And then we've got Company C, which is also a base period employer only. So Company A, if this person separates from Company A and they file a claim, Company A is going to receive a last employer claim, which is used to determine the person's eligibility based on their most recent separation. They will also receive a base period notice because they have wages in the base period. And the base period notice is simply to address financial liability. Now, companies B and C will only receive a base period notice, letting them know that they have liability and they'll be charged their share if the claimant is found eligible based on their separation from their most recent employer. Now, in most cases, for a reimbursing employer, base period claims are not protestable. And here's why. So with tax-paying employers, we talked about how they have to pay all this money in, even if they never use it. A lot of it is socialized and pooled costs, right? So what happens is if you're a tax-paying employer and someone leaves and quits your organization and they didn't file a claim at that point, they go work somewhere else maybe, and maybe that other employer lays them off. And now when the state looks at the look back period, you're a potentially chargeable employer. Well, the state is not going to penalize someone's benefits for a separation that happened 6-8 months ago, that it's not what prompted them to file the claim, right? Okay, you quit one job and you went to work somewhere else, but then your new employer is the one that laid you off. That's a qualifying separation, right? And so basically what they're going to do is they're not going to penalize this person from collecting. They're going to base their entire eligibility based on the most recent employer. Now, typically then they'll go back and they'll charge those base period employers their portion. If you're a taxpayer, they won't count it. If the person like quit or was separated from misconduct from your company, you can protest the base period claim and say, you shouldn't charge us against my experience rating because they left for misconduct or whatever. And the state's still going to pay the person. They're just going to take it out of that socialized money, that socialized pool. But if you're self-insured and you're a reimbursing employer, in most states, you just have to pay your part because you're not paying into that socialized pool. Usually you still come out on the better end, right? Because you're not paying all those socialized fees. But that's why in most states, reimbursing employers don't get to protest those base period claims. Now, there are some states that have exceptions. We'll talk about those in a minute. There's always exceptions, right? And I do want to just give a quick disclaimer. This session is meant to be a general understanding of how unemployment works. We couldn't possibly get into every state exception because each state has their own sort of criteria. We have to do the best we can to generalize. But if you would like to talk through your specific state and, your specific state's, rules and regulations about unemployment, I'm happy to do that with you offline. We can totally walk through your specific state, but I have to keep it kind of general for the purposes of, educating everyone. So now in this example, you will see that the wages paid by these three employers was $50,000, okay? So if the claimant's found eligible from, company A, from their most recent employer, this person's weekly benefit amount would probably be about $480 a week, because remember, it's roughly meant to be about 50% of what they earned on average while they were employed. Now, 36 out of the 50 states charge proportionately based on your percentage of the wages you paid. So in this example, if the claimant's eligible, right, you've got company A, we'll say they paid 10% of the total wages in that base period or that look back period. And so they would be responsible for 10% of the benefit. So if this person's making $480 a week in unemployment, company A is going to be responsible for 10% or $48 per week. Company B in this example paid $20,000 or 40% of the total base period wages, and so they would pay 40% of the benefits or $192 per week. And company C paid 25,000 or 50% of the wages, and so they would be responsible for 50% of the benefits, and so or $240 a week. So again, there's a few states that do other like weird things, like Massachusetts. They are going to charge each employer in inverse order. So they'll figure out what the person's eligible for, so say the $480 per week, and they'll start charging just that most recent employer until their liability part runs out. Then they'll move to company B until theirs runs out, and if the person's still collecting, then they'll move to company C. So there are states that do it like that. There's a few, and then there's some that just charge the last employer all of it. So again, if you want to understand your specific state, feel free to reach out to me directly, but most states do charge proportional, which is why we use that in this particular example. Now, we talked about base period protest rights for reimbursing employers, that some of them have different provisions. I'm not going to walk through all of these states. You can download a copy of the presentation in the handout section and see if your state's on here. But just as an example, like in Colorado, reimbursing employers can protest all base period claims. There's no specific provision, right? But then you've got states like Minnesota that it had to be a separation for gross misconduct only, so theft, dishonesty, violence, that sort of thing, then they can protest those base period claims. Another example would be Pennsylvania. They have something called a solvency fee. Every year, the state sends out a notice to the employers that says, hey, if you pay this one-time lump sum fee, you have the right to protest base period claims. So basically, you're paying into that socialized pool, which is why you then have the right to protest. You'd have to evaluate at that point, which is more financially beneficial for me. So I know I just keep mentioning exceptions. And again, I do apologize for that. Every state's a little bit different, but that's what we're here for. So we're happy to help you walk through all of these things at any time. All right, so next we're going to talk about the different types of separations. We're going to get into some effective documentation and adjudication strategies. I will tell you that, unemployment is very gray. It's not black and white by any means. Each situation is going to be a little bit different. And the goal behind this section of the presentation, we call it winning the claim before it's filed. So we're going to go through what the state is looking at, how they're making their decisions. We're going to talk about best practices so that you know that you're winning and all the claims that you can be winning, essentially. And the reality is that the time to win the claim is not after the person separates and actually files the claim. It's while the person is still working for you. Because once they leave, it's too late. You can't go back and create the effective documentation trail that you're going to need to win that claim. So that's what we're going to talk about now is what are you going to need in that employee file when time comes for the claim and how to best present each case. Okay, so there are 3 types of job separation that are recognized in unemployment adjudication. And every single separation is going to be, lumped into one of these 3 categories. Once the state determines the type of separation, that's going to then dictate the flow of how the claim is adjudicated and who has the burden of proof. Now, the state determines which category the separation falls in by looking at factors such as who was the moving party that initiated separation from employment and was continuing work available. So for example, the first category is discharges. Obviously, you've got your common discharges. Everybody knows violations of policy, gross misconduct, that those are discharges. What you might not know is that suspensions and mutual agreements are going to be adjudicated as a discharge. Because if you think about like a suspension, who's the moving party in that separation? The employer. Is continuing work available? No, the employer is separating the individual. So that's why it's a discharge. Same with a mutual agreement. Okay, you guys might agree that it's just not working out. So we're going to let you quit, or we're just going to let you leave. We're not going to fire you and put that on your record. But guess what? Continuing work would not have been available for this person if they hadn't left. Meaning, if they didn't leave voluntarily or, willingly, you were going to discharge them. So the state is going to adjudicate that as a discharge. Doesn't matter what you call it. It matters what happened in that scenario, right? So then voluntary quit. You've got your typical resignations, your repeated no-call, no-shows. Those are pretty obvious. But leave of absence. A leave of absence is going to be adjudicated as a voluntary quit because typically it's the employee that is requesting the leave and is separating themselves from employment. And then we've got that last and third category, which is lack of work, okay? And, obviously if you eliminate someone's position, if you lay them off, reduce their hours, that's all going to be considered a lack of work. The ones that get a little bit tricky are, temporary work, seasonal work, part-time employment, which is another one that's very controversial, and we will get more into that here in just a bit. First one we're going to talk about is discharges. If I can get my slide to change. There we go. All right. So typically with a discharge, the burden of proof is going to be on the former employer. They're going to have to prove that the employee was discharged for misconduct. The state generally defines misconduct as a deliberate and willful disregard of an employer's interest or repeated violations of a known policy. So keep in mind, it is very possible for an employee to be discharged for cause and it still not meet the state's definition of misconduct. So in essence, you could make a very good, solid business decision per your policies to separate an employee, yet they may still qualify for unemployment. So just understand that. It doesn't mean you did anything wrong if the state says there was no misconduct. It just means that your definition and their definition might not be the same. So here's what I want to do. I want to walk through some of the trickier discharge separations, the ones that are a little more difficult to win, and walk through why they adjudicate the way that they do. So let's talk about an isolated incident, okay? An individual that is terminated for a policy violation but didn't have any prior warnings for a similar infraction, the state will typically rule that as an isolated incident of poor judgment. So this comes up most often when employers have a progressive discipline policy and the employee's violations were what we refer to as a mixed bag. So maybe the employee had a verbal warning for dress code, a written warning for attendance, a final warning for attendance, but maybe the final incident that resulted in termination was violation of company social media policy. Well, the state is going to typically want to see at least one prior warning for a similar infraction to whatever the final incident was, unless, of course, it's gross misconduct, right? Gross misconduct like violent theft, you don't need prior warnings. But for any other discharge, they are going to want to see that this person had at least one prior warning for a similar thing, or they're going to say, yeah, that was just an isolated incident of poor judgment. They've never been warned about this before. Another one, which is sort of similar, but not quite exactly the same, would be a good faith error. So usually with a good faith error, they didn't have any prior warnings for the same thing, and maybe they thought they were doing what was in the best interest of the company. So a good example that I saw firsthand, I used to handle claims for a very large retailer that everybody is familiar with, and they're very sensitive to lawsuits, right? And so they have a zero tolerance policy for their loss prevention department for approaching individuals once they've left the building and have reached the parking lot, okay? So if their loss prevention department sees somebody take merchandise, their goal is to address or approach the person before they step off the sidewalk. And because of all kinds of risk to lawsuits, they have a zero tolerance policy on this. Well, there was a new loss prevention person, very passionate about the job, was certain somebody had merchandise on their person and couldn't get to them in time, and made the decision in the heat of the moment to approach them in the parking lot. And that person got fired. And they did violate the rule. They did know the rule, but they thought they were doing what was in the company's best interest. They were not trying to hurt the company by keeping this person from stealing, right? So you can kind of see where that good faith error comes in. If they've never been warned about it before and you terminate them with no prior warning, it's usually going to fall into that good faith error category. So let's talk about attendance. Attendance is probably one of the more frustrating ones. Obviously, if people don't come to work, we can't run a business. We can't operate without people. But the state is usually going to look at the reason for the very final absence. And if it was beyond the person's control, a lot of times they're going to rule that as not deliberate misconduct. And this does vary greatly by state, okay? But most of the time, if someone follows the policy, properly reports the absence, they're sick or their child is sick, the state's going to say, it doesn't matter how many absences they had. If a person is sick, if they're sick and they can't come to work. So you may have made a good business decision in terminating them, but they're not going to be ineligible for unemployment. Now, if there's a policy violation, you're going to have a better shot, and you should really try to focus on that. So what I mean is, if your policy says, well, you're required to call in at least, 1 hour before your shift starts, and you're supposed to talk to your direct manager or supervisor. And maybe the person doesn't call in until 15 minutes after their shift is supposed to start, and they just text their coworker, Barb, and they're like, hey, Barb, can you let, Bob know I'm not going to be in today? Obviously, that is not per the policy. They didn't properly report it. They didn't do it in the right way. So that could be deemed something that was within their control. That was a policy violation. So know your attendance policy, document the reasons for absences. If they didn't properly handle the reporting of the absence, make sure you note that. It absolutely comes into play, and it may be your best shot. Also, if somebody says they overslept, or, any other thing that, like, I took a bunch of cough syrup and couldn't get up in the morning. I mean, these are all things that are within someone's control. And so those are the types of details that you're going to need if you want to win an attendance case. Okay. Again, some states are more employee friendly than others when it comes to this attendance issue. So here's what I'll say. A, follow your policy. Always follow it uniformly for every employee. They don't want to see people vary, right? You got to follow it all the time. Provide a copy of that policy. Provide copies of warnings showing that they kept violating the attendance policy. If, like, they were supposed to provide a doctor's note and the policy says that and they didn't, make a note of that. And then provide all of this information up front. If the initial decision comes back and the state says, yeah, we got that, we get it, they were absent a lot, but it's not misconduct, it was beyond their control, what have you, I don't recommend appealing that to a hearing. You're not going to change the state's definition of what constitutes misconduct and what doesn't, right? However, if the facts are in dispute, you got to remember the state is looking at what the claimant is telling them and what the employer is telling them, and they got to make a decision. And when in doubt, they're probably going to lean to the claimant, right? So when the decision comes back, if the facts are in dispute, then absolutely appeal that attendance case. If you feel that there was misconduct or that there was something within that employee's control, and the state isn't recognizing that within that initial decision, then absolutely appeal it. But otherwise, I'd say let it go, right? Give your best effort to give them all the data up front. If they don't rule in your favor, most of the time, you're going to want to let attendance go. It's not worth your effort to keep going on that. And you'll know in your state if you typically win those types of cases or not, right? You'll see those come back. So the last one I want to talk about is poor performance. And this one gets an entire slide of its own. It can be a little bit controversial. All right. So an easy way to think about unsatisfactory work performance is wouldn't versus couldn't. Okay, so the worker wouldn't do the job or the worker couldn't do the job. The state feels that it's the employer's responsibility to choose the right person for the job, the person that is most qualified. Okay, so a million warnings is in a personal, improvement plan is not going to make performance misconduct. It's just not. If the employee has never been able to meet your performance standards since starting the job, it will be deemed as inability to perform the job. State will say, sorry, employer, you hired an unqualified person, and the person will be eligible for benefits. Okay? Now, there are situations where a worker has worked for you for some time, and they've previously been able to meet the performance standards and have been doing the job at acceptable levels, and now for whatever reason, they're not, right? And their duties haven't changed. Now, if their job has changed, that kind of starts the clock over, right? But if their job has been the same, and for whatever reason now, they're just not performing, then that could be considered misconduct. The key is that you have to prove through prior performance evaluations that this person had been able to meet the job requirements previously, and now for whatever reason, they are choosing not to perform. And what I would say is, in this instance, it's actually best not to present the case as performance at all. All too often, if the state adjudicators see the word performance or unsatisfactory performance on that response, they're going to immediately close their minds and open those checkbooks. It's usually better, if you can, to maybe focus on a policy violation, like whatever occurred on the final incident. And here's what I'll say about this. It's very common for employers to use performance or bad performance, poor performance as sort of just an overarching code, sort of an umbrella catch-all situation. But I want to remind you, the state doesn't care how you code something in your system. So maybe you don't have a lot of options in your system and performance was the best way to code it. Okay, fine. They're not looking in your HRIS system. They want to know the details of what occurred, and then they'll decide sort of what that falls into. And so I would say, if you've got somebody that's not performing and they violated some sort of policy or rule on that final incident, the final thing that made you decide to discharge them, focus on that. Call it a policy violation. Present the policy they violated. Don't call it performance. Now, if you can't find a specific policy, but you know it was like deliberately just not doing their job, then there are other codes out there, like you could call it misconduct related performance, or, there's another one that basically implies like I deliberately wasn't performing or wasn't doing the job. That's what you would want to use. Because again, as soon as they see that inability, they're gonna want to go the other way. So if there really was misconduct, just make sure you present it that way. Now, let me give you an example to illustrate the difference between the same case that would be in one instance, considered misconduct, and in another poor performance. So say you hire an employee and part of their job requires them to drive a company-issued vehicle. And you have a policy stating that a certain number of accidents would result in termination. Makes sense, right? Well, I can tell you, it doesn't matter how many accidents this person has. You're never going to prove that someone intentionally drove their car, into another car or into that guardrail or whatever. They're just not a very good driver. You hired somebody that's not good at driving to drive a car. That wouldn't be a performance-related issue, inability to perform job, right? Now, on the flip side, let's say the employee was texting while driving. Maybe they were under the influence of something. Maybe they took some sleepy cough medicine. Any policy violation that caused the accident, right? Well, now you have misconduct. And when you present that case, focus on the policy violation that caused the accident, not on their lack of driving skills. So do you see the difference there? The other thing is key terms, right? If you're considering something to be deliberate or misconduct, use the language that would imply that. I'm going to give you another real example. We had a customer that they have a call center. And so all the employees that work in the call center, they have a policy called call avoidance. You're not allowed to purposefully avoid incoming calls because their entire job is to provide customer service by answering the phone. Well, in this particular instance, the employer won the initial claim. They protested it, saying the person was deliberately, avoiding calls. They'd been warned. They violated the policy. They won. The claimant appealed it. It went to a hearing. And when the hearing decision came back, the state actually overturned it in the claimant's favor, saying that by the employer's, quote, own admission, the claimant's mistake was staying away from the phone too long. So all because the employer went to the hearing and used the word mistake, now the state's like, oh, it was an oopsie doopsie. I stayed away from the phone too long by accident, instead of I was deliberately avoiding incoming customer calls, right? So it really is that trivial. It's all about the language and the key terms that you use. So let's talk about the types of documentation. We talked about adequacy earlier. What is the state looking for? Well, we talked about how in a discharge, burden of proof's on the employer. So they're going to want a lot of information. So the first thing, well, obviously the dates of employment, you're going to need that for every separation. But besides that, the first thing you're going to want to provide is what were the details of the final incident. Straw that broke the camel's back, okay? Do not write a paragraph about everything this person's ever done since they've been employed. That is a terrible idea. They want to know what was the very last thing. And then don't include anything that happened after. So say you brought this person in to terminate their employment and, because they, attendance, right, or whatever, and they get upset and, I don't know, maybe they punch a wall or throw a chair across the room. Don't even bother mentioning that stuff because it's irrelevant. It did not impact your decision to terminate them. It's whatever the final incident was that they did that you said, it's time to terminate their employment, okay? You also do not want to be vague. You want to be very detailed. Don't just say the person was separated for insubordination. That's not good enough. How were they insubordinate? What did they say? Who did they say it to? What actions did you take when this occurred? So you'll definitely want to provide all of that. Then you'll need to provide a copy of whatever policy this person violated or whatever policy you're following that resulted in discharge, okay? The state will want to see a copy of it because they're going to want to see that you followed the policy, and they're going to want to also confirm that the employee broke the policy. Then you're going to need the employee's acknowledgement of said policy. So you don't have to prove that they read the policies, okay? You just have to prove that they were provided to them. So if they signed something that says, I'm in receipt of the company handbook, I'll read all the policies, that's all you need, something like that. Or maybe they did like an online checkbox that says, I've gotten the policies, or something that says, that they were made aware of the policies. That's all you need. You just have to show so that the person can't say, well, I wasn't aware that was the policy. That's why you need that. Now we'll get into the history portion of it. Now the state's going to want to look at the entire worker's history. So now they're going to want to see any corrective actions, prior warnings, etc. And even verbal warnings are valuable. So note them in detail in the person's file. What did you say to them? Who said it? On what date? Okay. Verbal warnings are still relative, but you won't remember them if you don't, write them down and have a record of that. Witness statements are very helpful, but I'm going to caution you about witness statements. Be careful. Anything that you provide in an unemployment case is public record to the claimant. So if you've got a sensitive situation and you took witness statements from hourly employees or coworkers and you have concerns about retaliation, don't send witness statements. It's not worth it. It's not worth it for an unemployment claim to potentially jeopardize someone's safety. So if you are ever concerned about that, do not provide the witness statements. If it's a manager's witness statement and you're comfortable providing it, then by all means do so. They're very, very helpful. I do want to reiterate again that some, situations are ground for immediate discharge. Obviously, you wouldn't need prior warnings in those situations if it's violence, theft, things of that nature. You would just need those details, copy of the policy, and the person's acknowledgement, and again, witness statements if applicable and if you feel comfortable sending them. Now, the other thing about corrective actions, warnings, those types of things, you really want to ask the employee to sign these, and it's not an admission of guilt. The signature simply is acknowledgement that they were talked to and that they received this warning, so that they can't say, well, I never got a copy of this warning. You're just simply trying to get them to acknowledge receipt. So what I would say is if the person doesn't feel comfortable signing it, you can try this. You could say, okay, just so you know, this is not an admission of guilt, but if you're not comfortable signing it, can you simply write, I refuse to sign, or I disagree with this, and then maybe initial it? That would be a good way to do it. But if not, always have a witness, another manager, another supervisor there when you do these things. And then if you can both sign off that it was given to the employee, that is helpful as well. Again, you're just trying to show that the person did in fact receive these warnings. Okay, so let's talk about voluntary quits. These are much easier, okay? So with a voluntary quit, the burden of proof is going to be on the former employee. They've got to prove that they quit with good cause attributable to the employer. They also have to show that they exhausted all reasonable options before making the decision to quit. So there's some situations that could be considered good cause, such as like a change in the condition of someone's employment. So say that you hired someone to work day shift Monday through Friday, but now you need them to start working on some weekends or evenings. And if they say they can't change their schedule and you leave them no option but to quit, that would be considered good cause because you changed the condition of their employment. Or maybe you hired someone to be a bookkeeper and maybe you need them to fill in now on the phones as a receptionist 3 days a week. You can certainly ask them to do that and they're welcome to do it, but maybe that person isn't comfortable talking on the phone and they weren't hired to talk on the phone. So if they're not willing to do it and you leave them no choice, again, you change the condition of their employment, that would be considered good cause. Another example of good cause would be if the employer reported being harassed or a hostile work environment and the employer did not take the proper steps to resolve the situation. Now, the key here is that the employee had to have reported it. This is critical. Again, they have to exhaust all options before making the decision to quit. They can't just quit and then tell the state, well, I was being harassed, but they never gave the employer an opportunity to resolve the situation. So if someone comes to you with a report of harassment or hostile work environment, make sure that you document the procedure, the investigation that took place, and what you did to try to resolve this for that employee. The state is not going to expect you to resolve every situation to the employee's satisfaction. You just have to show that you took the appropriate steps, you addressed it, and the employee still chose to quit, right? That would be on them. Because again, they have to exhaust all options before making the decision to quit. Again, forced resignation, mutual agreements, I'm letting you quit instead of getting fired, those are discharges. They're not quits. Your records might say that it's a quit for their employment records because you agreed to do that, write it down as a resignation. But when it comes time for the unemployment claim, the state's going to say, well, if the person hadn't quit, would continuing work have been available? If the answer is no, it's a discharge. Doesn't mean you can't win the case. It just means now you've got to provide all the burden of proof shifts back to you. So now you've got to provide all the details and the documentation for misconduct. So effective documentation for a quit, again, much more straightforward, dates of employment, reason provided by the employee. That's really the gist of it. I mean, as long as you provide that, you'll be considered to have been in compliance. Now, what will help you more? Written letter of resignation is great. Oftentimes individuals will tell the state something different than they tell the employer. So if you've got it in writing, that's extremely helpful. Even if you don't have it in writing, I mean, if you have a text message, an email, that all counts. If they called and talked to somebody, document when they called, who they spoke with, what they said, right? That's really what you need. I mean, at the end of the day, I do want to say that with everything, there are exceptions. There are states that have what we call compelling voluntary quits or compelling need. And so sometimes they will allow the person to collect, even if it's not attributable to the employer. So some examples of that would be, say the person's spouse gets a better job making more money and they have to move to another city. The state, a lot of states will allow that person to collect as long as they're actively seeking work and are still available for work in their new city, because they're not going to separate families. And this, the spouse had to do what was best for them and taking a better, more, they call it more remunerative. I don't say that word very well, but basically it's better employment. They have the right to do that. And the spouse, of course, would move with the spouse. So a lot of states have a provision like that. Again, they have to be proving that they're actively looking for work in their new city, right? Another one would be like domestic violence. So if someone's in a domestic violence situation and they need to flee the area for their safety, a lot of times, again, the state is going to allow them to collect. So just know there are some voluntary quits that you're not going to be able to do anything about. But in general, someone voluntarily separates. It's pretty easy. You just got to provide some of the basic information, and you should be good to go on that. So one thing I will say, though, is no call, no shows. Know your state's rules. Most states require 3 consecutive days of no call, no show before it's considered to be a quit. There's 2 states that I know that require 5 days. New Jersey and Alabama require 5 days of no call, no shows before they'll consider it a quit and not a discharge. Now, obviously, if the person's no call, no showing, and if they have an attendance problem with warnings, you absolutely can do it as a discharge, and you'll probably win because they violated a policy by no call, no showing. But if you can document 3 consecutive days, well, now you can change it in your records from a discharge to job abandonment. And again, the burden of proof then will be on the former employee, so you're going to be better off. So again, know your state. If it's 3 days, 5 days, mark those days down, the days they were scheduled to work and didn't show, provide those to the state, and you will most often win those cases for sure. Okay, so now we're going to talk about lack of work. Lack of work is the entire intent of unemployment, okay? It's not disqualifying. If you lay somebody off, eliminate their position, cut their hours, they're probably going to be eligible, provided they meet all the other requirements, right? They've got to remember they have to meet all the other requirements. Separation is only one piece of the puzzle. But there are some lack of works where people, where there might be situations where they should not be eligible to collect. And so what I want to do is I want to walk through some of the strategies for how to handle some of these interesting lack of work cases. And this is where we're going to talk about those seasonal, ski instructors or what have you. Here's the deal with, well, actually, we're going to start with part-time, then we'll get to the seasonal. So first of all, part-time. Part-time is one of those things that can be very frustrating. But understand that if a person's hours vary from week to week, it's not going to be protestable. It's going to be considered working all available hours, okay? So the state has 3 categories for part-time employment. There's regular part-time employment, which is, the person has, they work less than full-time, but they work the same schedule every week, okay? So obviously there could be some exceptions, but like if they pretty much always work Monday, Wednesday, Friday, 9 to noon, that's a regular part-time employee. And typically most states are going to relieve you of charges if someone who works regular part-time and has their job hasn't changed, nothing has changed, they're typically going to relieve you of charges. But the next category, works all available hours, this probably applies to a lot of employers here on the phone today. If you have an employee that works less than full-time, but their hours fluctuate week to week based upon business needs, and they are not putting restrictions on their hours, this could be considered part-time works all available hours, and they're typically it's going to be a lack of work, and they're going to be eligible for unemployment. Now, again, the key here is whether or not the employee or the employer is dictating the hour fluctuations, right? So if the employee has another full-time job or another job somewhere and they've got restrictions, that's important, and you would want to note that. Where this typically comes into play is if you have a part-time person that works for you, maybe a couple days, a few hours a week, maybe they've got a regular full-time employer. And this happened a ton during the pandemic, right? They may have lost their full-time employment, so they file a claim. Remember, they're not filing against you. Even though you're still employing them, it's not like the employee says, I want to file a claim against XYZ employer. That's not how it works. They file a claim. The state says, okay, which employers are paying this person during the base period? And then those employers are going to get claims. Now, when I said earlier that there's a monetary component, and I said there's a historical and then there's a current component to that. Well, if the person, first they're going to see, okay, did the person earn enough in the base period to be eligible? Okay, yes, they are. Okay, we see that this person is currently earning some wages, maybe from another part-time employer. So now they're going to look and see, is this person earning too much to get unemployment? So the way that works is state's going to look at all the wages from all employers because they just got laid off from their full-time employment. They're going to say, okay, this person, so let's use the previous example. They're eligible to collect $480 a week, okay? And the state's going to, each state has a different partial calculation, okay? But there's typically some sort of an offset. So maybe you, as the part-time employer, are paying them, you know, I don't know, $300 a week in part-time work. Well, the state's going to look at that. They're going to type those wages into their partial calculation, and then they're going to determine, okay, yes, this person is eligible for a partial benefit or they're not. And you, as that part-time employer, are usually on the hook for your portion because the employee is not restricting their hours. They're accepting all available work. So the only way to avoid paying unemployment is to offer them more hours, pay them, you know, get them working more and earning more. Unemployment's only representing 50% of their normal wages. So if you can get their hours up, they're not going to be eligible for unemployment, right? And then you're fulfilling time slots or work that needs to be done. So that's really the best way to do that. Now, the other thing too, is if you see a claim come in for someone that's working for you part-time, if you have the work, offer them more hours. If they take it, they won't collect unemployment, right? If they refuse it, you can report that to the state because we talked earlier about availability. The person has to be available and actively seeking work. So if they refuse additional shifts and it's the same type of work and same pay that they're used to doing, report it, and the state will typically then disqualify them for not accepting all available work. So that's a good strategy there. On-call casual employees, you know, they work as needed. They have no regular schedule. This could be like per diem or, you know, maybe in-home worker or something like that. Whenever they finish an assignment, they a lot of times will file claims in between assignments. Yeah, that's lack of work. It's not protestable. However, availability, again, can be questioned. So maybe their assignment ends, they file a claim, but maybe you offer them a new assignment and they refuse it, right? So that is typically how that is going to work. Regular part-time is the only type of part-time work that is actually protestable, but you can protest availability, you know, on these other areas. So some tips and strategies for part-time work, right? If you can provide a set schedule and set hours per week, great, do that, okay? If you can't, okay, fine. Did the claimant request part-time? So do they have restrictions? If they've got another full-time employer, they might have restrictions. You need to call those out and notify the state that this person is restricting the amount of hours they can work for me. You know, has their schedule recently changed and why? If they request a change in availability, get that in writing. If they used to work 3 days a week and they say, I'm going to be going to school now on Wednesday nights and I can't work Wednesday nights anymore, get it in writing, okay? If they're making changes and restrictions to their availability, they're not going to be eligible. And just know that, again, not all states provide relief for part-time work. Most of them will if it's regular part-time. And again, if they're earning enough money, it's not going to be an issue anyway. So offer them more hours if you can. I mean, that's going to be, you know, the best way. And so again, on the availability issues, the state's going to want to know if they're accepting all available hours. You need to document refusals. And when we talk about refusals, they're going to want to know if it was the same type of work, how much pay was offered, you know, is it within like the normal things that they would be doing? Like you can't offer them something totally crazy and off the wall. If they refuse that, the state's going to not consider that a bona fide offer, right? So it has to be what they normally do. And again, we already talked about this, availability changes in writing. And this is an interesting one. Offer hours and assignments to those who have filed claims first. So what I mean by this is you know who's filing claims. You get a notification every time someone files an unemployment claim. At the time that they file the claim, it could be legitimate. Maybe they just finished an assignment, even seasonal work, whatever, right? Maybe and we'll talk more about seasonal here in a minute, but maybe they just finished something and it's a lack of work. okay? And their claim is legitimate. Well, but then maybe a week or two later, you have you have work available. Instead of posting that maybe out to the general public or something like that, maybe use your unemployment list of who's filed as like a recall list. So what I mean by that is, like, think about staffing agencies, temporary staffing agencies. They obviously have people going in and out of temporary work constantly. And so they're always getting claims. I can tell you this is a best practice for staffing agencies, right? And so if you have per diem workers or on-call workers, like, you should do something similar. Anybody who's filed a claim recently, those are the people you offer assignments or work to first, because one of two things will happen. They'll either go back to work and not collect and stop collecting unemployment, or they will refuse said work, and you can report the availability issue to the state, and they will get disqualified. All right, let's talk about seasonal employment and specifically summer camp employees, but we'll talk about seasonal in general. Here's the deal. To answer the question earlier, yes, seasonal employees are most often eligible for unemployment when the season ends if they've met all the other criteria. The reason for this is that the state is not going to penalize somebody for taking temporary work, okay? So if the state were to say, well, we want you to go back to work and stop collecting unemployment, but if you take a temporary job, we're going to disqualify you once that job is over. That's not how it works. It doesn't matter if they knew going in that the job was only 7 weeks or 10 weeks or whatever it is. They are going to be eligible. If there is no work when that assignment is over and they are still actively seeking work but no work is available, they will be eligible for unemployment. Now, depending on how long they worked for you and what state you're in, you may or may not even be charged for that. They only worked for you. Maybe you hired, obviously this would apply more to retail, but you'll get the gist. If you hire somebody for seasonal, like Christmas help, like maybe you work at a mall, like a mall store, and you hire somebody for Christmas help and they only work for you for 4 weeks, and then they go file a claim, you might get a claim as their last employer. So they might be eligible because their assignment ended with you. That doesn't mean you're going to be charged. You're not in the base period. You have no wages yet. Remember, first 4, last 5 completed quarters, you're not even going to be charged for that. So a lot of times with seasonal employment, depending on how long it is, you may or may not be in the base period, but understand that when you hire temporary employers or employees, you are on the hook for unemployment if they're not independent contractors, right? Now, each state has its own rules about what's an independent contractor, and it's actually pretty hard to classify somebody as an independent contractor. Obviously, they are not eligible for unemployment, independent contractors, right? But if you hire a temporary contract employee that you are directing their work and you are directing their hours and all of that, yes, they will be eligible every single time. So if you've got other work, offer it to them, or just know that when they separate, they are going to be eligible, depending on whether or not you're in that base period, will depend on whether or not you're charged. I want to talk about summer camp employees because a lot of our nonprofit employers have summer camps, and there are the same provisions apply as all seasonal employment, but there are some states that do exempt camp staff from unemployment coverage. Oh, and you know what? Let me backtrack on that seasonal, like the ski instructors thing. You should check and see if your state has a seasonal law, or if you want, you can reach out to me after the webinar and I can do a little research for you. Some states do have seasonal laws, and there are some categories of work that are deemed seasonal, and, like construction workers or like maybe certain farming things, there are certain jobs that the state will say, okay, we have a seasonal provision and they wouldn't qualify. So it is going to depend. That will depend on your state because a lot of states do not have a seasonal provision. So the one with the ski instructor question, maybe if you're not sure, you can Google it, or you can reach out to me and I'm happy to research it for you and see if your state maybe has. And really what it's going to come down to then is if your state does have that provision, you shouldn't be reporting their wages. But I'm going to talk more about that in just a second. So same with the camp staff, right? A lot of states, not all, have an exemption under their policies regarding unemployment coverage. And so you have to meet the certain criteria. Now, these states that I've listed here, these are the states that we're aware of that have this exemption. Obviously, the rules change all the time, and we're not a payroll company. So you would want to work with your payroll company, because a lot of times don't even know this, but find out if camp staff is exempt in your state or not, but these are the ones that we know of. And they have to be employed less than 13 weeks. The camp must operate for less than 7 months a year to qualify. And then if you meet those criteria and in these states, make sure, this is the key, that you exclude the wages from your quarterly contribution reports to the state. So that's the same if your state has a seasonal provision, you would again want to exclude, because what happens is if you have a camp employee and you're reporting their wages on those quarterly wage reports, the quarterly contribution reports, it's a lack of work when the camp ends. So the state is going to pay them unemployment. But if you're in one of these states, they're not eligible, you need to exclude the wages and not report them because they're not subject wages in your state. So just be mindful of that. A lot of times payroll companies get this wrong. So make sure you do your research and talk with your payroll company and just make sure that that you're not including these wages. It's the same with like AmeriCorps employees, right? Like those are not Conservation Corps, right? These are not employees. And a lot of times employers mistakenly report their wages to unemployment. So when the state goes back to that base period, they see eligible wages and the actual separation is lack of work, they're going to pay them. So please, know these provisions exist. And another thing about lack of work claims, know your state's severance rules, because that might impact how you structure a separation. If your state doesn't look at severance at all, you may choose not to give severance because they're going to collect unemployment, right? Some states won't even look at severance pay or even consider it. Doesn't matter if you give them $1 million, they don't care. They can still collect unemployment. Whereas other states say, yeah, no, we're going to deduct it. We're going to allocate it out over so many weeks. They won't be able to collect during those weeks. So just know how and how your state looks at it. It also matters whether it's paid via a lump sum or like allocated payments. That can matter based in your state. And again, same with the camp employees. If your state does not consider severance to be covered or subject wages, make sure you do not report those wages on your quarterly contribution reports. So why I say that is here's what happens. If you report those wages to the state, and so let's say that person files a claim, they collect for, claims are good for 1 year or until they hit their maximum, right? But then the next year they can file another claim. That's a new base period. Well, now maybe those severance wages that you reported are in the base period. You might now have to pay more benefits again because they have more eligible wages based off of severance pay, which is separation pay. And so if your state does not consider that to be covered, make sure you do not report that, or you could be adding liability for yourself. And then last but not least, for lack of work, consider using reemployment services to reduce liability. Anybody who's a member of the 501c agency's trust of our organization, this is included in your membership. You have access to reemployment services. So if you have to it only counts for layoffs, right? But if you have to lay some people off, contact us about reemployment services. Number one, it helps that employee with a quicker transition back into the workforce. It makes that job separation a little less, it maybe creates a little less anxiety for them. And it gets them back to work faster, which means less unemployment payments, right? This is a free service to you. I highly recommend you utilize that to, reduce your unemployment benefit liability. All right, how are we on time? All right, we're still good. I'm gonna check questions and then we'll do the last piece on appeals and hearings. See if we have any more questions. We do. Okay. If the employers, okay. Sorry, these boxes, these are very tiny. Okay, if a claim decision is made by unemployment before I submitted the paperwork requested, do I still need to submit the paperwork, especially if it's past the date it needed to be submitted by? Well, here's what I would say. Probably not. Probably not. If you're not, I mean, you'd be, you wouldn't really be able to appeal that because you were untimely in the initial response. A lot of times the states say, yeah, we're not even, some states will let you appeal an untimely claim. But I would say if your intent is not to appeal the untimely claim, or if you're in a state that won't let you appeal the untimely claim, then yeah, I mean, once it's past the due date, honestly, there's really no reason, unless you just want to have it submitted for the records. And so it's all there. But honestly, no, there's not going to be any, like, if you're not going to appeal it or do any subsequent action, then no, it will count as against the pattern clause because you missed the deadline. So just know that. But other than that, it's going to happen either way. So there's really no point. No, you don't really need to provide it after the fact. Let's see. I have a lot of employees who refuse to sign. Yeah, so if they refuse to sign, again, I would say just on those warnings, ask them to write, I don't agree with this, I protest, whatever makes them feel good. If they won't do that, then have a witness there, another supervisor that can sign that says that it was given to the employee, and then you should be fine. Is the employer dinged for those cases where an employee moves with spouse? Yeah, and you probably typed that before I mentioned that. Yes, a lot of times they are. Again, it's going to depend on your specific state and the situation at hand, and if they meet all of the other criteria. And taxpayers, it can be a little bit different because they might get relieved of, the charge against their experience rating because they pay into those socialized costs, right? And the state might take it out of that. But yeah, so basically, yes, a lot of times they will let someone collect in that scenario where the spouse has a better job and you have to move with your spouse. Okay, so somebody asked for clarification. You said if someone is a regular part-time employee and their hours are reduced or they are laid off, the employer would be relieved of charges by UI. And am I understanding that correct? The employee wouldn't be held liable for the lack of work. Let me read that. Regular part-time and their hours. Okay, no. So if they are regular part-time and their hours haven't changed, okay, so maybe they work for you 3 days a week and they have another employer that separates them and they file a claim, you can protest that they still work for you regular part-time, nothing has changed, 3 days a week, that was the agreement upon hire, nothing has changed. Now, if you reduce their hours or they're laid off, then absolutely they're going to be able to collect. You've now changed their condition of employment with you. This is really more, the regular part-time thing is more if someone just, I don't know, gets a wild thought that, hey, maybe they don't have another job and they're like, hey, somebody told me if I work part-time, I can apply for unemployment. Well, if they're working part-time and regular and their hours don't vary, they're not going to be eligible. Or if they have a full-time employer and they are found eligible, you most of the times are not going to be charged if they're still working regular part-time for you. So their hours do not fluctuate. So hopefully I clarified that a little bit better and that made sense. Oh, okay. So somebody asked if I could explain reasonable assurance. So reasonable assurance is something that often occurs with educational institutions. So say you have summer breaks. Every state has different rules on reasonable assurance, and it applies to different staff. So typically reasonable assurance is going to apply to your professional staff, such as teachers and principals, et cetera. So basically what happens is you have to issue them a letter at the end of the year that says you have reasonable assurance to return after the summer break or the summer session, and saying, yes, we are likely to bring you back in the fall. You have reasonable assurance. When you do that, that person is often not eligible for unemployment during the summer break because they are a teacher. They usually get paid their full year wages through the school year. So maybe they're not earning during the summer, but that's how it's set up. They've earned it all sort of in advance, if you will. I mean, that's kind of why reasonable assurance exists. Again, there are some caveats, but typically you got to make sure you get them those letters before the end of the school year. And then you would reply when you get it. If somebody files, you would say, this person is a teacher, a full-time teacher. They have reasonable assurance to return in the fall. more times than not, they are not going to be eligible to collect benefits. Substitutes are tricky, and the thing with substitutes, like during the school year, they sort of fall into that per diem as needed bucket. So they can collect in between assignments. So it is a lot of work, but you really should be tracking when they refuse, because if they file, you should report that. And with the summer breaks, it's really going to depend on how they're classified and your state's rules. It's usually pretty easy to find reasonable assurance rules online for your state. If you just type in, if you live in California reasonable assurance, a lot of times they'll have like an FAQ that tells you which employees qualify under reasonable assurance and which ones don't. It's the same, by the way, for like Christmas breaks and stuff, but you don't have to give them the letter. It's just assumed, right? Let's see. If we had a lack of funding for W-2 employment and offered a consulting agreement with almost the same amount of pay, how would the state take that as pretty much we only had another budget for consultancy? Okay. So it depends on whether that consultant is going to be deemed like an independent contractor or not, but they're still going to be required to report those wages. So like if you lay somebody off and you bring them back as a consultant, there's a couple things that could happen. They could take the job and then they would be earning wages and probably aren't going to qualify or even apply for unemployment because they're making money. But if they refuse the consultancy, maybe because they're not going to get benefits or something like that, the state's going to look at, okay, what did you offer them? What type of work was it? What was the pay? If there is some sort of a significant difference, so like say maybe healthcare, and they say, I can't accept a job without healthcare benefits, the state could rule that the refusal was for good cause. So it's just going to depend on the situation and what was offered and how the state views that. But yes, you could absolutely do it, and you could definitely explain to the state, but you need to make sure you say, how much were they making before? How much are you making now? What are the hours? What type of work is it? That type of thing. And then the state will determine whether it's considered a bona fide offer of work or not. Are there differences in effects of a UI claim that is approved, but we're not charged for the claim versus approved, but we are charged? How is that determined? Yes. So again, if the state says that the employee is approved, but the employer will not be charged, and I kind of mentioned some scenarios earlier where that can happen, the state will take the money out of sort of those socialized pools. And then, if the state says that the claimant is approved and the employer will be charged, then obviously it either gets charged, if you're a taxpayer, it gets charged against your experience rating and counts towards your rate the next year, or if you're a reimburser, you'll have to pay those benefits. But if they say the person's approved, but you're not charged, it does not count against you. So if you're a taxpayer, they don't charge your experience rating. If you're in a state where they allow reimbursers to get relief, the reimburser wouldn't pay it. It would come out of some other funding from the state. Okay, lots of questions. This is great. Can an after-school staff program be qualified? They only work during the time the school operates. Does any school teaching staff, okay, lessons or tutoring also qualify? Yes. So here's the thing with the summer school teaching or the summer staff, it has to be a full-time student, right? That whole summer camp thing, they have to be a full-time student to qualify for that exemption. Okay, so not the teachers, right? But when we look at like after-school staff, it depends on whether the institution that is doing this program is classified as either an educational institution or an educational service agency. So a lot of times after school programs for schools can be considered an educational service agency. And so the reasonable assurance provisions would apply, but a lot of times they are not considered that, and they would be eligible to collect in the summer. And so in order to avoid that, if you have a summer program that you can offer them work, and then if they refuse, you can go that route. Or if they take it, then obviously they're not collecting unemployment. But yes, it just depends. And I hate to give that caveat, but again, it does depend on, your specific state and what they consider to be an education, how you're classified, if you will. Okay, how can we confirm if we are a reimbursing employer? So so on your quarterly payroll report, so if you use a payroll provider, you can ask them, or if you have a payroll department, if you are paying unemployment taxes every quarter, you're not a reimburser, versus whether if you get a bill from the state every month or every quarter, depending on what state you're in, that you actually just pay a bill directly back to the state for the people that actually collected. That's kind of how you would know. There are some other ways that we could probably help you figure that out, or to dissect that. If you want to reach out to me, I can probably help you figure that out. But yeah, the best way is to look at those quarterly contribution reports and see if your tax rate is 0. Or if you're in New Jersey, Pennsylvania, or Alaska, if you only have that tiny like employee portion that you're paying, but the rest there's no other rate, that's how you would know. So if your rate is 0, you're a reimburser. If you have a tax rate, like a full-on tax rate, then you are not. And even if you are a nonprofit and you're paying the taxes, every state has like a deadline when you can request to get out of the tax system every year. And then you mentioned the reemployment services. Can you share a little bit more on that? Yeah, so basically it's like, it goes through we use a third party called NextJobs, and they will help that employee. They get them connected with resume assistance, job board postings, things like that. Depending on if you have like an upper level separation, maybe somebody that was an upper level, had a, I don't know, maybe a director or vice president, something like that. They can be eligible for like an even, higher level. Okay, so many questions I was not anticipating, and we are out of time. I will look at the remaining questions and see if I can reach out to you directly, and I'll send you an email I've never had this many questions before. We've probably never gone over time, but I will go through the questions. I will make sure I respond to your email that you registered with the webinar with directly, but great questions, guys. For the last piece was just the hearings tips, which the reality is you just want to make sure you have a firsthand witness. I mean, that's really the key. Somebody that was involved in the separation, and just make sure that you stay calm and address the facts. Go in the order we talked about, what was the final incident, then give sort of the historical context, try to remain unemotional, those types of things. Sorry, we didn't get into that too much. If you're part of our services, if you're a member with us, you do get hearing representation. And so they help you, they hold your hand through the hearing, they participate with you. So they'll walk you through and prep you and do all of that. So again, I'm really sorry that we ran out of time. Just had so many great questions. This was probably one of the highest attended webinars that we've had in a long time. So I will get answers out on the questions that we didn't get to go through today. Again, if you need those SHRM or HCRI credits, fill out the survey that you'll get after the presentation, and then give us 24 hours and they'll get those codes out to you. And again, if you want a copy of the presentation, it's in the handouts toolbar. So thank you again for joining us today. If you have any questions about your specific state or want to talk to me directly, my email address is nkorn@501c.com. So that's nkorn@501c.com. I'm happy to walk through those state exceptions with you if you need some help there. Hope you learned something today. Thanks for spending an hour and a half with me. Have a great rest of the day. Thanks, everybody.